Hi, Bob Gersh here with East Coast Capital. And today we're going to do a presentation, and let's see if we can bring it on here. Okay. And just bear with me a second here. Have to find. Here we are. Okay. So again, it's Bob Gersh with East Coast Capital. And today our presentation is, let's see if I can get my picture away from, the wording. So I'm up in my right-hand corner. Reverse Mortgages for Real Estate Professionals by Bob Gersh. I'm a real estate reverse mortgage specialist. Okay. So an overview of the senior market. And bear with me, I'm still trying to adjust myself here. I think that works. Okay. So there are 35 million of us seniors age 65 plus in the US. That's our market, 7,500 plus turning 65 each day. It's a growing market. Incredible potential. The 85 plus is the fastest growing segment of this population. And as we all know, we get to a certain point, our income doesn't seem to increase, but our expenses have slowly but surely over the years facing increased financial difficulty for us. So who are the baby boomers? They're born between 1946 and 1964. They're estimated to number approximately 77 million folks. This puts increased pressure on Social Security and Medicare. The seniors as homeowners. 75% age 65 and over are homeowners. Most own the homes free and clear. And it keeps growing, approximately $3 trillion of untapped equity in those homes. The largest portion of net worth for most of us as seniors is tied up in the home. The challenges seniors face: 90% rely on Social Security. Rising cost of health care and medication, a continuous concern. Depleted investment portfolios. The longer you live, that's great news, but in a lot of cases, you are invading the principal of that portfolio and slowly over a period of time. And you have to also look at one of the items is that a lot of times you may still have the assets, but if they're in fixed income, bonds, etc., the income may be the same, but the purchasing power has gone down in these. So again, we're depleting our purchasing power. Folks have fixed income, but expenses keep increasing to pay for the items with that same fixed income. Reduced pensions. Again, in certain cases, the businesses that are behind, or municipalities or other organizations behind the payment on those pensions, sometimes that pension may not, the underlying organization that's providing the pension may or may not be able to continue paying at the rate they were paying, and may, just so they don't run out of money, reduce your pensions. Some contracts may also reduce over a period of time, depending on, they may be tied to Social Security or other indexes. Fixed income and rising expenses, as I mentioned earlier. Challenge to seniors, a burden on your children You may not want it to be a burden, but that may occur. There is, in this world today, in the 2020 era, with a pandemic around, increased foreclosures. There may be restrictions on being able to foreclose, but those aren't forever. Folks find themselves in a position, if they're in a business or otherwise, that they may end up not having the income they had, can't support their being in a place, and ultimately a foreclosure may end up being something that they're concerned about. Bankruptcies, the same thing. So the reverse mortgage could be the solution. It may help. You need to be 62 or older and a homeowner. You can convert a portion of the home equity, the proceeds, loan proceeds, tax-free, no repayment, while at least one borrower occupies the property as your primary residence. More basic facts. The homeowner retains title. That's always a concern. You know, who's going to own the property? Well, homeowner retains title. I'll repeat again. The home is the sole collateral for this type of loan. Not looking at your other assets, your bank accounts, your investments, etc. It is solely the home which is collateral. The availability of funds is based on a few factors. The home's appraisal value, it's an FHA independent appraisal that is done. It factors in the age of the youngest borrower, and it's also uses, since it's an annuity type program, it utilizes the current interest rates in calculating how much is available now based on your age, interest rates, and the home's appraisal value. So as either of those go up or down, the numbers can change. Okay, your responsibilities as a homeowner. You need to occupy the property as the primary residence. You need to pay your real estate taxes, your homeowner's insurance. You need to keep them current. And you need to, in general, maintain the property in good condition. Okay, what can the borrower do with the money that they get? I mean, it's the why. You know, what's in it for the borrower? Why do this? Well, necessities can be paid for to avoid foreclosure or bankruptcy that we talked about before. One of the biggest issues that seniors have is paying medical bills, and not all covered by insurance. And therefore, you need that extra money to be able to help keep those paid. Medication expenses, older you get, it seems more prescriptions are being prescribed for you, and you need to be able to pay for them. In-home care, again, you want to be able to stay in your home as long as it's safe. And to do that, you may need to bring people in to help you with that. And so you need to be able to pay for that. Meeting monthly obligations, again, your obligations, are, going and spending extra money on extra things beyond what you need. The other hand, just doing that, all costs seem to be going up, of everything from your utilities to your cable bills and your insurance bills, and just, everything you need to have to live, just to get food and to be able to survive. Homes, as they get older, need repairs. Also, you may need modifications, things, grab bars, other things may be needed. Maybe need to redo your bathroom or kitchen to make it more appropriate for your being able to cook and, basically maintain, as well as, exterior and interior things need to be modified, repaired, maintained over a period of time. And so older it gets, the more your house needs your, concern. HVAC systems, the roof, etc., things that need to be done, and you need to be able to pay for that. Then there's your wants that you may have, which, we're human beings and we want to be able to do certain things. And even small little things, we want the luxuries of being able to, have things like funding your long-term care in your home. It makes sense. You need to bring people in and you need to pay for certain expenses, which come under a long-term care policy. You may qualify for it, but now you got to pay for it. Well, we have that house that, sitting the roof over our heads. Some of the equity from that house may be to pay for the long-term travel. At the moment, a lot of us aren't doing much travel, but in the long run, people have on their want list to see part of the rest of the United States or someplace in the world may be very important to be able to travel or travel to see people, if not places. Gifts to children or grandchildren, help them out. You have the equity in your property. You have the luxury of having that. And your kids or grandkids may need that extra boost financially. Well, you'd be able to do that. Purchasing of another property, maybe you're in a situation where us folks that are transplants down to Florida realize in the middle of the summer we get over 100-degree temperatures. We'd prefer maybe to spend a few months in someplace that's not as hot, so that you may want a place up north or someplace else for a little part of the year, understanding we still want to, whatever house we're using for this loan, to make sure it's our primary residence and qualifies in that manner. Charitable giving, again, it may be the time to be able to help others and have some resource to do that. Purchase a new vehicle. Vehicles don't usually last forever. I keep mine longer than I probably should. But, when it comes to purchasing a new one, having that extra availability of funds can make that transaction a lot more viable. And just to enjoy retirement, enjoy life in general. History of the reverse mortgages, 1961, the first in the United States, initially thought of as a program of last resort. A lot of people think about that. Clearly, like a lot of financial transactions, it can be used in many ways. So we don't want to pigeonhole it into saying it's just last resort. No one gets it unless it's a desire, emergency. Well, no. As we just mentioned previously, there are a lot of luxury or on your want list, the to-do list, things you want to do, and you need the finances for that. Those aren't the last resort. That's more just being able to enjoy life and utilize the equity in your house potentially for that purpose. In the late 1980s, the FHA started insuring reverse mortgages, call them home equity conversion mortgages, or HECM. And the program anticipates to grow over the next 20 years with the baby boomers flowing through that and onward. Types of reverse mortgages. There's your home equity conversion mortgage, FHA, insured. And we have proprietary, which certain lenders will have them. Why have proprietary? Well, depending on the situation, you may have property with values which are significantly greater than the amounts that are available through the FHA program. And therefore that multi-million-dollar condo and condos in general of certain sizes and price ranges. So lenders have come up with some programs which has a lot of the same features, but a little bit different. They don't have an FHA insurance attached to them, and they may have dollar amounts which will start off where the FHA limits stop. So suggestion is we look at all programs that you might qualify for, and therefore there is some flexibility in programs, both governmental insured and in lender company owned. The FHA HECM is the most popular. 90% of all the reverses are the home equity conversion mortgage. The benefits with that FHA is there is insurance, and that will allow certain things to occur, such as it makes sure that the lenders get paid no matter what. It's non-recourse, which means we're only looking at the property, as we mentioned before, not looking at the individuals, and the current low interest rates, because it is an FHA product, and therefore the lenders look at it as less risk, if any, no risk, basically, to the lenders because they get paid through the FHA insurance. Okay, options for how to take the money. Lump sum, and I'm talking about on a refinancing now. You pay off your existing mortgage, since this becomes your new mortgage. You can use funds to, you could stop there at just paying off that mortgage, and the new mortgage, you'll have no monthly payments on the mortgage itself. Large purchases, some people, large purchase would be boat, RV, other items of that nature, gifts to children, etc. The monthly amount, one way to take it is take it in monthly amounts. It'll supplement your existing cash flow, so you'll be able to have more funds to be able to pay those bills on a monthly basis. You can set up amounts, and you can change those amounts as time goes on. Long-term care expenses, you can make the payments towards maintaining the premiums on that. You can establish a line of credit and just use it whenever you need to for unexpected expenses, when it's a rainy day, when the roof needs repair, or the HVAC goes, or the new car needs new brakes. Take funds only when needed, if you choose. There's also a growth feature, and that growth feature, we could have a whole separate session on that. The growth feature is the funds that are in that line of credit will each month, when you get a monthly statement, you'll get that statement, and you could proceed to each month see that there is growth of that amount. And that's a calculation which is based on the interest rate that you're paying and the FHA insurance fee. And pretty much you add the two together and you get how much the interest rate is that will be the growth rate. It's just an increase of your line of credit. Some people will literally take out a reverse mortgage, take the expenses of a reverse mortgage, which are built into the loan, and except for an appraisal and a counseling fee, basically those will be just built into the loan. But you could take that initial loan and pay down those over a period of time. You could be paying down the upfront expenses, and at certain points you owe zero. The line of credit, by paying them down, you'll have more money in that line, and that line will continue every month to grow. The growth of all of that, maybe over 5 years, 10 years, 20 years, whatever, will literally increase significantly, multiple times the amount of your initial available line. And although the value of property may go up or down, it won't affect, the value of property won't affect the fact you'll have an increase in that growth rate. That is a building fund, which you may never need it, but it can be a fund which will be there. I'm looking outside. You may be hearing in the background some thunder. It is a rainy day out here today. Just started. Just want to mention that in case someone's wondering what that noise in the background is. So the growth rate can be part of your, again, different people will use a reverse mortgage for different functions. And one function is to build that fund for emergencies in the future, or for an additional nest egg. So as certain investments or other income would be depleted, or the expenses go up and you start needing that extra money, you could basically build that fund, build your own future annuity. And that's something that you would talk about with someone like myself and your investment advisors, your tax people, how you can be able to grow that fund over a period of time. So it's not just using it today to pay bills today, but also how to have long-term planning with this tool. So, and you can use a combination of all of the above to pay expenses, take out funds when needed, to let funds just grow there for the future. or any pot, and the amounts that you're taking out can be changed. So that if you take out a set monthly amount and things change, you could either reduce or increase the amount you get per month. So, you know, it's all about the numbers. And if you're buying a house or refinancing a house, you know, what are the numbers going to look like? Well, if you go to our calculator at askbobgersh.com and click on calculator, it'll bring you to the part of the website which has a calculator. You'd put in the zip code that you're looking at. You'd look at your age of yourself and your significant other, and basically your estimate value of the property. If there's an existing house and you're looking to refinance an existing mortgage, you'd put in the amount of the mortgage, and it would come up with all the numbers for you as to, based on all the information, how much you would receive in that line of credit, how much you could receive if you're drawing funds out. It would also give you information if you're looking to buy a house, how much you'd have to come to closing, including all of the standard closing costs are calculated into the calculator, so that you could be able to say, well, okay, I have so much money from the sale of a house. I'm moving to Florida, buying another house. And if I put this down, how much of a house can I get? All those numbers can be done through this calculator, which is available 24/7 online. Okay, so if I'm a realtor, but this also, you know, if just as a buyer or seller of a property, or just as a consumer or a professional, you know, same thing as a realtor, why do I need to know about reverse mortgages? Okay, and the first thing I would say is, if you are a professional, you want to distinguish yourself. If you're a consumer, you also want to become a professional and understand how things work. You want to set yourself apart. There is a senior real estate designation, and I know a lot of realtors that I work with have that designation. Part of that course does talk about reverse mortgages, but you'd like to be able to be in a position when someone says reverse mortgages, it should be, oh, okay, here's how it works and here's what you need to do, rather than, well, I really don't know much about it, I'll have to check with somebody. You want to become a professional. That's why we're here, to be able to answer all your questions, and would be more than happy to have a Zoom chat one-on-one with anyone, just to talk further and answer any open questions you have and discuss the matter so you too can be a professional. You want to be seen as an advisor, so we can be your backup team to make you a known advisor. Communicate with the family. You want to be able to talk to folks and the buyer and their family, their kids, their relatives, and the folks that they have as trusted advisors. Turning one transaction into two. Someone's looking to sell a property, downsize, and move to Florida and buy a property. You can handle the sale of a property for a realtor, and also buying a property, that transaction. And you can be able to look at the overall picture, the big picture, when you're looking at situations. So you want to look at all assets that a person has, their liabilities, their income, their expenses, and how this product could be a tool utilized a little differently depending on your situation. That's the great part. It's built to be a tool rather than a one-off product that's used only one way. So you want to be able to look at the big picture and use this as part of that. A senior can purchase a home using the FHA-insured HECM, as we mentioned before. There's a positive impact for the senior and for the realtor, or if you're a financial advisor or a tax person, or many, many occupations. The fact that you can be part of this transaction, folks may be able to then afford to stay at home or sell, downsize, or upsize, move closer to the kids or further away from the kids. You can do lots of things. So you'd have this tool, you can make a positive impact for seniors and for yourself and your business potentially. Taking a quick example on the purchase side, the 65-year-old client sells their current home. They have $160,000 in cash proceeds. They purchase a new home, new primary home, for $300,000. So the cash from the sale is $160,000. The reverse proceeds, the mortgage, is $140,000. That will equal the $300,000 purchase price. Typically, with that $160,000 cash down, not only can we pay for the balance of the house, the $140,000, but included in the financing will be the closing costs, so that you're only bringing $160,000 in total to the closing. You just helped the senior buy a $300,000 home with no mortgage payments ever, as we described. What have you done here? Help the senior purchase a home that better meets his or her needs. Again, downsizing, I mentioned the maintenance. You want to have maybe a one-level living, mobility issues, not walking the steps. Maybe it's closer to public transportation. Maybe it's just the community, which has all kind of features, like where I am here in Central Florida, in the Villages. You may want to be closer to the kids. It's one of the first questions I ask. Have you considered that when looking at a house and looking, financially, they have issues? Should you sell the house? Should you maintain the house? Well, maybe you should sell them. And one of the real relevant issues is closer to the kids. Or maybe you just want to make sure there's a place when the kids come down, where they can stay. And if they don't come down that often, maybe as someone mentioned the other day, you want to have the finances so you could be able to help them in that hotel they're going to stay at nearby. You don't need the extra space because they don't hear that often, but you want to be able to help them be able to afford to come down. Or you may want to literally sell your house and move closer to the kids and buy something in the area where they are. So all those options are open to you. When is the reverse mortgage due and payable? We mentioned no monthly payments, but certain things would trigger off the payoff a reverse mortgage. The borrowers, if they pass away, move, or sell, okay, then it's not your primary residence. The last borrower on the deed no longer occupies the home as the primary residence. 6 months to pay off. That can be extended. People ask, well, how quickly do we have to get out, and what the deal is if the last surviving spouse has passed away, or other events occur. In that case, you want to always communicate with your lender, the servicer, what you're planning to do. Communicate ahead of time. And if a situation where, let's say, the kids want the home, after the last spouse who occupied the house has passed away, the kids could potentially arrange, and there's a lot more details that you'd want to talk to us about to do this, and the advantages under certain circumstances, depending on the value of the property and the amount of the loan. There are cases where the kids can be able to acquire that property at 95% of the then fair market value through the FHA appraisal, which means that you may not have to pay off all of that loan. Again, we just look at the property for the loan, not the individuals, not the estate or the kids. So there may be a time period you say, I still like that property, in which case you have time to arrange for new financing to pay off the existing financing. And that may take some time. Or if you're looking to sell that property through and pay off at the time you sell it, the loan, but things take time sometimes. And so there is forms to be filled out to have a 6-month time period, and then you can extend it. And again, you want to talk to your servicer, your lender, and to make sure that we stay in compliance with all of that. But it's not a complicated process, but there is, the procedures that take place, making everyone, happy with the results. Okay, you want additional information? My name is Bob Gersh, again with East Coast Capital, and you can reach me at 352-561-3096, or email me at rgersh@eastcoastcap.com. Do have a website which has the phone number, our email address, and other information, which is on here, seniormortgages.now.site. Also, when you go to that seniormortgages.now.site, you will find that there is connections to social media, Facebook and others, which will give us our various social media. We have Facebook pages on reverse mortgages and mortgages in general. Also, askbobgersh.com is one of my regular websites. And at the bottom of that, scrolling down there, you will see a number of blogs. We do Monday through Friday, a blog each day. Also, further down at the bottom, you will see information regarding the various social media, Facebook, LinkedIn, YouTube, etc. And you can be able to click on those to see information. And we have on the YouTube many, many videos like this one, which you can be able to watch and get more information. And you can also send us an email request, and we can send you the link to be able to schedule a Zoom session to be able to, at your convenience, talk person to person. We can bring multiple people in on it, so different family members or different locations, we can from the convenience of their various locations and homes, be able to bring them into a Zoom session and go over the details and get more information. So you don't have to be person to person. We can stay safe and be able to do that, and convenient. So that's the information. You may want to take that information down to reach us and to get more details. The seniormortgages.now site also has a blog on different mortgage and real estate related topics, and typically it's 2 blog posts per day, 7 days a week. So that's even more information you can gather. I hope this has been of value to you. I've enjoyed being able to present this to you. You don't need to be a realtor to use this information, but we feel it's good for the realtors to know, as well as, if you're interested in being a buyer or seller of a property, which may have a reverse mortgage or looking to do a reverse mortgage, or you're a family member